Afternoon, for those of you who are in Moldova. Today's lecture on Section 199A, 678 trusts, and complex trusts was canceled for lack of interest, but then it was reinstated for lack of planning to cancel it in time. Today, we're going to talk about an important income tax provision, Section 199, capital A. There wasn't room for it otherwise, so they had to make a new subsection, capital A. Stands for pain in the donkey. This provision gives you a 20% tax deduction for qualified business income. What happened was that the corporate tax came down to 21%, and all the people who pay income tax on business income were going to be very jealous and not vote for their favorite politicians anymore. So we all got together and decided to come up with a new tax deduction that if you have a business and it meets certain requirements, then you will pay tax only based upon 80% of the otherwise applicable rate. But if you're really, really rich and you make a lot of money, you better make sure that you pay a lot of wages or have a lot of real estate or other depreciable items. That concludes our talk on Section 199A. Now, Alan Gassman, who I find to be pretty uninteresting and not at all funny, will speak on planning with Section 199A and 678 trusts and complex trusts. Now, I'm going to listen carefully, and then later we'll be asking questions. Thank you very much, and don't forget to vote in the next election. Thank you. Right. Welcome, everybody. Thank you very much for that rousing introduction. We're going to talk today about planning with Section 199A trusts, and I welcome your questions, comments, and suggestions. I will be checking the questions during the presentation and also after the presentation. I can answer emails at agassman@gassmanpa.com. This presentation does not qualify for continuing education credit because it's not good enough, but maybe in the future we will get something to qualify for continuing education credit. To ask a question, go to the question panel on the little sideways rectangular item there and write in your question. If you click on the pyramid, it'll allow you to write in your question. Your question should begin with the words, "What a great presentation. I have a question." That's a really good way to begin a question, and then we will answer the questions that I know the answers to. Please join us next Saturday at 11 a.m. My friend and mentor, Jerry Hash, and I are going to talk about nuts, bolts, and innovative strategies for charitable planning. And then on Saturday, March 19th, what estate planners need to know about Florida law for their snowbird clients. And if you're a Floridian, you may want to join us too. And my friend Eric Schweitzer is going to talk on physical therapy and yoga, what the two professions borrow ideas from each other, what each should know about the other. And then March 26th, we're going to talk about spousal limited access trusts. And my wife Marcia is going to watch that because she does not like to be limited. So we're going to talk about what we mean by limited. And April 9th, we're going to talk about hot topics and best strategies for estate planning. And Marty Shinkman is going to join us and talk about the human aspects of tax planning. I will speak on the inhuman or inhumane aspects of tax planning. Our Saturday webinars are in our YouTube library. And now let me mention that Tuesday, March 15th for Lineberg Information Services, we are going to talk on the new proposed IRA regulations in this not so free presentation. And we're looking forward to what we say, because then after we say it, we'll know it. And the Section 199A book is on Amazon. So if you don't have anything better to do today than to read an entire book on 199A, you have that opportunity courtesy of Amazon. So under Internal Revenue Code Section 199A, there is a 20% income tax deduction on active trade or business income. This can come through an S corporation, partnership, or the Schedule C or Schedule E or Schedule F for farming of a taxpayer's Form 1040. It does not apply to C corporations. Even charitable organizations can use it if they pay income tax on their unrelated business taxable income, and even estates can get this deduction. And quite frankly, when the law passed in 2017, we got real excited about it, and we started applying it in creative ways in 2018 and 2019. And then as we were getting used to it, 2020 came along with the COVID virus, and everyone then thought that this might be temporary if the Democrats took over control of the House and Senate, which they did. But it's still out there. It's still an opportunity, and there's still a lot of people not doing the type of planning that they can do. And to refresh your memory, qualified business income is active business income. If I have a triple net lease of a warehouse to somebody and they handle everything, they just pay me a rent check, I cannot get a 20% deduction on my rent income. So it might be worthwhile for me as the landlord to become active and provide them with maintenance and janitorial and parking assistance and maybe other services so that I can become active and only pay tax at 80% of the otherwise applicable rate. So landlords should be approaching tenants to enable the landlord to become a trade or business. And we have a lot of information on that and on our Forbes blog about specifically real estate becoming qualified for 199A. So I think the other definitions here we'll take as we go. Now, if you are a married couple with less than $340,100 of taxable income, then you qualify for the 199A deduction. Doesn't matter what kind of trade or business you're in or how much wages or property you have, you qualify. And if you're lucky enough to be single, then the threshold is $170,050. Now, if you're over 340 but under 440 in income, there's a phase out, a rateable phase out. And if you're single, if you're between 170 and 220, there's a phase out. So these are the 2022 levels. I've not updated our PowerPoints. The law clerks are going to do that over the summer. So when you see 170 and 340 for 2022 right there on page 20, elsewhere you see 315 and 157. Those are the old numbers. For 2022, it's 170 and 340. So here are the limitations for people who have income of over 170 single or 340 married. If you are in a specified service, trade, or business, and you are over 220 or 440, then you don't get this deduction. So how do you get your income down, or how do you shift the income to people in lower brackets? And what is a specified trade or business? It's really more of a profession than it is a business. If you're a lawyer, if you're an actuary, if you're an accountant, if you're a real estate broker, those are not considered to be active businesses once you have a certain income level. And we will cover that more thoroughly in the next few minutes, although it'll seem longer than a few minutes. Secondly, no matter what business you're in, if your business makes, say, $1 million a year, and it's not a law practice, it's not a medical practice, it's just a regular old business, it makes $1 million a year, and that million comes to you by K1 income through your S corporation or through your partnership, you don't get that deduction unless you have paid enough wages to people, which may include yourself. And the proportion of wages, it comes out to 28.7%. So if I had $1 million coming out of my company and I did all the work and it's a Schedule C, I get no deduction. But on the other hand, let's say I hire my nephew and my niece and they start doing the work and I pay them $287,000 a year between the two of them. My remaining profit of just over $700,000 a year can all qualify for the Section 199A deduction. So those are the two limitations. Now, the other way to do it is instead of having enough wages, I could have wages plus 2.5% of the value or the cost of certain real estate and other assets. And I'm not going to go into tremendous detail there, but it's in our book, and it is also in the articles that we posted on Forbes. Now, one thing to think about is if you had 4 separate rental properties in 4 separate entities, that's probably not enough to have 4 trades or businesses to get the 199A deduction. But if you contribute all those 4 houses to one LLC and run the 4 houses as one business, that might be enough. So that's just one factor in 199A planning. We typically like to have a separate rental house in each LLC. So if there's a bad accident in one, you don't lose them all. But putting them all into one entity might be preferable. So what you might do is have Holdco established as one entity which owns 4 separate disregarded LLCs. So now you have your state law limitation on liabilities of each LLC seeping through to the others, but you consider Holdco to be one entity. So slide 22 is better than slide 21. That's the trade or business discussion. Now, one common mistake we see now is when people call before the 2017 Tax Act, they called and said, well, I have a business, I'm going to make $150,000, $170,000 a year. I'm a driver, I'm an independent contractor driver, or I make fences. And the automatic answer used to be set up an S corporation. Set up an S corporation, take some of your profits out as dividends, some as wages, and you won't have to pay wage tax on your dividends. So you'll save a lot of money. But the problem with an S corporation is you have to pay reasonable salary. And the salary doesn't qualify for the 199A deduction. So would you rather save 14% employment taxes, or would you rather save 20% income? And therefore, a lot more small businesses should be on the Schedule C of their income tax return or on a partnership return, as opposed to being in an S corporation. Because S corporations, as I said, require payment of reasonable salary to the owner. Okay, so here are the specified trades or businesses which get punished if they make too much money. Anything in the health industry, which has to do with doctors or chiropractors, legal, accounting, actuary, performing arts, consulting, athletics, financial services, brokerage services, investing in securities, and where the reputation or skill of one or more of its employees is what the principal asset is. So now, we have a lot of detail on this in the book. But for example, I've opened a separate S corporation called Haddon Hall Publishing. And a lot of you have actually contributed to the profits of Haddon Hall Publishing by buying our books on Amazon, attending our Lineberg webinars, or buying Estate View software. All of those things are under Haddon Hall Publishing. In addition, when I serve as trustee of a trust, the money for that goes to Haddon Hall Publishing. And when I act as an expert witness, that money goes to Haddon Hall Publishing. Haddon Hall Publishing pays me a small salary, as small as reasonably possible, pays salaries to people who help me, and then the remaining net income qualifies for Section 199A deduction. Alternatively, if Haddon Hall Publishing is on the Schedule C of my Form 1040 tax return, it does not have to pay me a salary. I'll be subject to more employment taxes, but I'll get the 199A deduction. So for law firms, that also includes writing title insurance. So a lot of different professions have the ability to peel off some income. And that may be research facilities for healthcare providers. Again, it's just something to think about. Okay. Now, here is a specified trade or business that instead of the traditional owner owning it, you simply give it to your children, or you give part ownership to your children. Because let's say your child number one is a school teacher and makes $60,000 a year. You give child one enough ownership to get him up to $170,000 a year. That's $100,000 a year of income from the SSTB. Now child one is in a lower tax bracket than the original owner and gets that 20% deduction. So child two is married, her threshold is going to be, as we said, $340,000. So we really want to think about who we can push this income to. So remember that taxpayers have standard deductions. So when you say when the threshold was 157, the real income that a single person would be able to make is 169, because 169 minus the standard deduction of 12 is 157. So when I say 180, I mean 192. And when I say 340, because the standard deduction for a married couple is about 25,000, I mean 345. So those of you who are accountants out there understand what I'm saying. And what is the savings? The savings can be significant. If you're looking at 20% of 172,900, you're at 12,794 in saved income taxes from the lower brackets and the 199A deduction, plus you're usually saving the 3.8% Medicare tax. So per child, you could be saving $20,000 a year. That's not a bad amount to save. If you have 4 children that can qualify for this, you're saving $80,000 a year. That's worth a little bit of restructuring. Now there is the kiddie tax. Now, when I first heard about this, I was excited because I don't really like cats, and I thought they were finally going to tax people who have cats more than the rest of us who have dogs or aardvarks, which are very cute. So the kiddie tax was changed in 2017. If you have a child under age 19 or as a full-time student up to age 24, then that child is in a much higher bracket on unearned income once they get to about $13,000. So what if my granddaughter, who doesn't have any other income, receives $13,000 worth of income from part ownership of a company? Well, that's going to save $2,200 in taxes. It's not a tremendous amount of money, but it still saves $2,200 in taxes. But once that child has unearned income of $13,000, then that child is subject to the highest tax rate, 37%, and the 3.8% Medicare rate. But still, saving $2,100 per grandchild is nothing to sneeze from, and we'll show you some fairly easy ways to make that happen. One potential loophole is how you get a child to not be subject to the kiddie tax, and the way to do that is to make the child self-supporting. So let's say that my granddaughter costs $40,000 a year to support. And let's say that there's a Gift to Minors Act with $100,000 in it, and that my daughter, as the agent under the Gift to Minors Act, takes $22,000 out from my granddaughter's money and uses it to defray expenses. Well, now my granddaughter, who's 3 years old, is providing more than 50% of her own support. And maybe she's not subject to the kiddie tax, and we could save a lot more if we put some income into her name. And if money comes from support by a 529 plan to a young college student, that can be a way to avoid the kiddie tax. Now, once the child reaches age 18, the other planning strategy is to tell them to drop out of school. Don't go to school. Get the 20% 199A deduction. I love it when the tax law encourages good behavior, and I just love it even more for the irony when the tax law says, tell your kid to drop out and not be a full-time student, and we'll save $20,000 a year of income taxes, which can buy a couple more surfboards and video games. Isn't that great? All right. So you have a high income taxpayer, no 199A deduction, taxes on 169.5 of income, $69,000. Now, you have a low income taxpayer with a 199 deduction, the first 169,500 of income, 23,000 of taxes. So 69,000 minus 23,000 is a total of $45,000 of income tax savings per child who does nothing. So children who do nothing maybe should be encouraged to do more of nothing. All right. Here is a summary of the type of entities that can own companies and partnerships and businesses and qualify for the 199A deduction and also do other cool things. There's the grantor trust. If I establish a trust for the benefit of my descendants and I retain the right to replace trust assets with assets of equal value or certain other rights, then that trust is disregarded for income tax return purposes. It stays on my Form 1040 tax return as if the trust did not exist. That trust could enter into a business and I could qualify for the 199A deduction, even though, assuming that my income is low enough or it pays enough wages, even though it will be out of my estate for estate tax purposes. Now, a complex trust is the name given to a trust which can accumulate income and will pay income tax on its own accumulated income. If I set up a trust for my children and I don't retain the right to replace trust assets with assets of equal value, and I'm not a beneficiary of the trust, and I don't retain certain other rights, then when that trust earns money during the year, if it doesn't distribute anything, it pays its own taxes. It's in the same tax rate as the child that I showed you. So a trust is in the top tax rate when it gets to about 13,000 of income, but until then, it's in a lower tax rate. So when a trust distributes money, it carries the income out. So if I set up a complex trust for my children and it has 200,000 of income, and the trustee distributes 100,000 to a child who has no income, and then another 90,000 to a child who has low income, and the child with 100,000 pays on tax on 100, the child with lower income pays tax on the 90, and the 10 that's left in the trust pays tax on at a lower bracket. That's a complex trust. And one nice thing about a complex trust is that it gets a $10,000 tax deduction, up to $10,000 for paying property taxes. So because I only get a $10,000 deduction under the 2017 Tax Act, and assuming that my home property taxes are 10,000 and that's all I get, what about my vacation home, which is another 10,000 a year of taxes? Well, I can put that into the complex trust, let the complex trust pay those taxes, and then it will get the tax deduction. If the complex trust becomes an owner in part of Haddon Hall Publishing, then if it receives income, it can qualify for the 199A deduction for up to $180,000 of income, which we'll cover later. There's exceptions, it's complicated. But if it gets 280,000 of income from Haddon Hall Publishing, because all of you buy so many more books this year, then it could make a payment to my granddaughter or my daughter and carry out the 199A deduction to them if I plan this correctly. Now, other alternatives include an electing small business trust, which I won't go over today, but it's out there and it's well suited to own S corporation stock. A Section 678 trust, which I'll cover later. A 678 trust under Internal Revenue Code Section 678, that's how brilliant the people were who named it, is like a grantor trust, except that the owner of the trust for income tax purposes is not the grantor. It's a person who has rights over the income or principal of the trust. So I can establish a Section 678 trust for my wife and granddaughter and pay income tax as if it was my granddaughter's income, qualify for the 199A deduction as if it was my granddaughter's income, yet use the trust for the benefit of my wife if we need it. Or my wife could shift the trust assets by exercise of a power of appointment, which to my granddaughter would be known as a power of disappointment, to other people if our granddaughter who pays the tax on the trust income becomes a disappointment. So that's why the 678 trust is so nice. I don't have to make my children and grandchildren owners of my business. I can make my wife or my best friend as trustee of trust for their benefit owners of the business, and then I get the tax result as if they were the owner, but I also get a good degree of control because I can replace the trustee of each of those trusts and suggest what they should do with the assets held in the trust. Isn't that nice? Now, when you have an S corporation, the stock has to be owned by a qualified S corporation owner. That could be a grantor trust or an individual. That could be an LLC owned by only one person. That could be a charitable organization. It could be a 501c3 organization, which would then pay income tax on the income from the S Corp. Could be a 678 trust. Could be an electing small business trust, which benefits foreigners. It used to be you couldn't have foreigners even benefit from ownership of an S Corp. Now you can. Now that's not to be confused with the banned forest foreigner. And the first 4 people who email me or send me a question telling me the name of a song by the band Foreigner, other than Double Vision, it can't be Double Vision, will get a free copy of my Section 199A book, whether you want it or not. Okay. Next. Got a chart that explains SBITs, which I'll skip. I have information about qualified subchapter S trusts. Here's another trick of the trade. If you want to have your S corporation stock owned by a qualified subchapter S trust for a child, you can do that, and then you can not make annual distributions by having an LLC owned by the trust which owns the company, which is treated as an S corporation. Maybe we could talk more about that later someday. So I'm going to skip a lot of these slides, and I'm going to show a lot of these slides in the next half hour. On page 44, got son who's married and mother of son who's married, and a company that makes $400,000 a year. The mother has $200,000 of income, the son has $200,000 of income jointly with their spouse. They're smiling because they get the 199A deduction. Now, mother, being the generous mother that she is, transfers 25% ownership to a complex trust. And now, or actually, I'm sorry, son transfers his 50% ownership to the complex trust. Or let's say mom owns 100% of the company. She transfers 50% ownership to the complex trust. She has 50%. Complex trust has 50%. Complex trust then transfers 100,000 to son. Under the attribution rules, if mother set this trust up to avoid 199A income tax or to get the deduction, then mom loses the advantage. So you have to use irrevocable trusts that are not set up to avoid the 199A tax. So the CPAs and lawyers out there have clients who have irrevocable trusts that were set up before this law even passed. They're usually set up when people die or when people are generous with their relatives and well planning. Those trusts can buy into existing businesses that are related to the client and then use 199A. But to set up a new trust to do this, you have to have a higher business purpose than the 199A savings. Okay. Let's go now to page 57. Another example of planning. Taxpayer and his partners, I was going to say friends, but usually after you've been partners a while, you're not friends. But taxpayer and his other partners own a partnership entity, LLC taxed as a partnership, and he is high earner. So he's not able to deduct to get the 199A deduction on his partnership income unless the partnership pays enough wages. But the wages paid to him don't count. There's a silly, unfair rule which says that when you make compensation payments from a partnership to a partner, they don't count as wages. And therefore, there's not enough wages paid by this partnership if it doesn't pay enough other people that 28.7% to get the full deduction. So he puts his partnership interest into an SCorp. This assumes that the basis of the partnership assets are not more than the debt owed by the partnership, because otherwise he would trigger gain. And now the partnership does pay him wages, but he's no longer the partner, technically. The S corporation is. So you do have situations out there where clients are not getting the deduction from a partnership entity. Maybe the partnership is a leasing entity. You need to make it more active. And then once you do your basis and debt check, think about conveying the partnership interest to an S corp and paying the client the 28.7% wage that would not be what we call a guaranteed payment under the tax law. Here's another idea for you. Spouse 1 owns the business and wants to make the wage payment. You can pay the wage to spouse 2 who has no entity ownership, and that will count. So that's how you keep your Schedule C business on your Schedule C without paying yourself a compensation. You pay the compensation to your spouse to maximize your 199A savings, because wages paid to the sole owner are not going to qualify as wages under that silly rule for high earners. Another thing you can do is get your income down. So in other words, let's say I make $600 a year, mostly dividends in my business. Well, if my business sets up a defined benefit pension plan, my salary can be reduced. And then I can give away part ownership of the business until I chip away and get my income, joint income under $352,000. So one way to do that is the pension plan, and consider a cross-tested defined benefit or cash balance pension plan to make that happen. And there's an example here on page 59 which shows you how little you need to put in for the rank and file employees and still be able to make this massive pension plan contribution. So fill out the census form and send it to your favorite actuary, or send it to me if you're a client of ours, and I'll send it to our favorite actuary. And the actuary won't charge to tell you what you could be putting away to get your income down to qualify under 199A and to have other advantages. So some people who are treated as employees, who wanted to be treated as employees to get benefits and to get the employer to pay half of the 14% employment tax, now want to be independent contractors to get the 20% 199A deduction. So we have literature and checklists on what it takes to become an independent contractor. That's also in the book and also on the Forbes blog. There's information here on what it takes to have enough qualified property to benefit from 199A. If you're a high earner and you don't have enough wages, you don't have to pay it all in wages if you go with the qualified property test. So hats off to those who do that. Now, I have an entirely separate PowerPoint deck for 199 and real estate, stepped up income tax basis, real estate brokers, and all that. If you want that deck, just let me know, and I will be glad to send it to you. Yes, Catherine, congratulations, you win the book. Foreigner Songs, I Want to Know What Love Is, Waiting for a Girl Like You, and Jukebox Hero. Way to go, those are great songs. And then Philip, you got it too, I Want to Know What Love Is. And okay, Scott says, did that question come from a Dirty White Boy? So I guess Dirty White Boy is another song that they probably wish they hadn't called it Dirty White Boy, but that's what they called it. Okay. So the primary purpose test is discussed at page 71. I got a real kick out of when Congress says a primary purpose. It's either the primary purpose or one of the primary purposes, because the word primary is different than the word a. So that made for a lot of confusion by me when I tried to write this book and our articles. So I just thought that was a lot of fun. Now, one thing that Congress did when they activated the Section 199A regulations was they also activated a regulation that I studied in law school in 1983 under Professor Dennis Calfee, who's still teaching there and is still one of my favorite people in the world. So the IRS comes out with Section 643F, as in Frank, and says, for purposes of trust tax law, that's subchapter J, has nothing to do with smoking joints, 2 or more trusts will be aggregated and treated as a single trust with only one $13,000 tax bracket between them if 1, they have substantially the same grantor or grantors, 2, substantially the same beneficiary or beneficiaries, and 3, a principal purpose is to avoid income tax. So, and then they said, to the extent provided in regulations, and the IRS never got around to passing regulations until August 16, 2018. So now when you do multiple trusts or 199A planning, you've got to worry about whether they're going to be pulled together into one trust. But if you have a client who already has multiple trusts because somebody died or because the planning took place well before you even thought about doing 199A planning, then it might still be worth using them. So here's an example of a situation that we did, that we handled with a client for Dr. and Mrs. Jones. They were very creatively named. And they had a medical practice. Dr. Jones was making about $350 a year in salary and about $4 million a year of income. He had a lot of employed physicians in the practice, so really he brought in about $700,000 to $800,000 a year. The other doctors brought in a lot. He has a lot of testing facilities and a surgical suite. So the income in the practice is pretty healthy. So what we could do is in Florida, we are able to set up trusts for spouse and children, which can own part of a medical practice and be taxed in the child's name. So as I showed you, you could save up to $40,000 a year per child, 3 children here, up to $120,000 a year of income tax savings. Now, on the other hand, if the Joneses live in a state that does not allow ownership of medical practice entities under the state law, then you can set up a practice management company, and Dr. Jones can donate his personal goodwill to the practice management company by signing a long-term employment agreement with a non-compete provision and entering into a practice management agreement with the practice itself. This is done every day in the United States by venture capitalists who own the economic rights to medical practices, and it's been permitted in all 50 of the states. It also is very common with dental practices. So then the practice management company sets up the 678 trusts, 1 for each child, grandchild, whoever's in a low bracket. The doctor's spouse is the trustee and a beneficiary, and that can save, as I said, a lot of income taxes. By the way, if you do this in Florida with a medical practice, please make sure you check with somebody who understands the Florida Clinical Licensing Act, and get a copy of the emails that Lester Perling and I exchanged with the Agency for Healthcare Administration, because you have to set up a sub-trust that the doctor is the trustee of, but he must obey the instructions of the 678 trust. It is similar to a land trust arrangement. Another idea is to set up a management company or a financial factoring company or some other business. So the medical practice deals with the business is owned by the child or the grandchildren, and the business shoots off income, which can qualify under 199A. Let that young adult under the age of 24 drop out of school and run the management of the company for a few years, see what life is about, and save 20%. So now you have to comply with the section 269A rules when you use a professional service company. The slides and a LISI article explain how to do that. Now I am back to complex trusts. So I want to talk for the next 10 minutes or so. As I say before, it'll seem longer, about the use of complex trusts. Complex trusts are underused, and as I said, I could establish an irrevocable trust, put $1 million of S corporation stock into the trust or partnership interest into the trust. The income flows from the S corporation into the complex trust. You can make an SBIT election. It's a complex trust now. What can the complex trust do? Well, the first thing it can do is it could donate a lot of money to charity and get a tax deduction for all of that. So let's say I make $1 million a year and I donate $500,000 to charity. And I would donate more to charity, but I can't get the tax deduction because of the 50% adjusted gross income limitation or the 60% limitation. Okay, I take my income producing partnership interest, I transfer it to the complex trust. Now that income goes to the complex trust, and the complex trust can give all of that income to the charity and get a deduction if it is properly drafted. If it is permitted to give its income to charity in the initial trust document. Now, if it doesn't have that language, you can add the language, but you would also have to have a partnership entity owned by the complex trust, and then the partnership would make the charitable donation, and then the complex trust would get credit for the charitable donation on its income tax return. Okay, that was easy, wasn't it? Secondly, as I said before, the complex trust can pay property taxes up to $10,000 a year and get a tax deduction. Number 3, here's what I really like about complex trusts: flexibility. Now, if I want my 3 children to go into business and I set up a business entity for them to own or for their 678 trust to own, if I set it up as a partnership, then they will have to get equal profits from the business. On the other hand, if I set it up as a complex trust, the trustee can spray the profits. I mean, if the children work there, they should receive a reasonable salary from the trust and employment taxes apply. But if they don't work there, the trustee can simply sprinkle the income to one or the other. The one who receives it will pay the tax. The one who doesn't receive it won't pay the tax, and it doesn't have to be equal. So my children will please be very nice to me, or I will replace the trustee with another trustee who will not sprinkle to the child who forgot to send me a Hanukkah card. Number 4, unlike partnerships where you really can't plan by making payments to partners, or SCorps where you would have to have your deductible expenses by the end of the year. The complex trust has a 65-day period, January 1 through March 5th. You can treat distributions made January 1 through March 5th as being from the previous year. So in January, I can sit down with my accountant and say, hey, this trust has $200,000 of income. I have until March 5th to dribble that out to my children and grandchildren and charities, and all of those distributions will be considered to have been made last year. So I can get the trust income down to 13,000 or down to zero, and I don't have to do it during the year. So you don't have the last minute hysteria. You just have the client who walks in the door March 3rd hysteria. Or maybe they're from hysteria. I don't know. Number 5, Jerry Hesh always says, don't talk about audits. You're not supposed to talk about doing things because it may or may not be audited. But every time I go to a big conference and the speaker goes, has anyone here ever seen the audit of a complex trust tax return? Nobody raises their hands. Now, maybe it's because they're all sleeping, because when you go to these conferences and they're talking about 1041s, it's not always that interesting. Or maybe it's because the IRS doesn't audit these types of returns. Now, that doesn't mean you should behave any differently, but enough said. With an S corporation, when I distribute appreciated assets to the shareholders directly or indirectly, I have to pay taxes if I sold the assets. With a complex trust, not. I can make a distribution of an appreciated asset to any beneficiary I want, and then the beneficiary simply takes the low tax basis. Number 7, I can give great grandpa the power to direct the trust assets to creditors of his estate when he dies, subject to the approval of my next door neighbor, which is exercisable in a non-fiduciary manner. Then when great grandpa dies, the assets in the trust get a new income tax basis equal to fair market value. Hooray! New depreciation on my building. So you have a building partnership. You want to get a 199A deduction and spread it. You put part ownership in a complex trust. Then when grandpa dies, you get a step up in the building. You can start depreciating it again, and also spray the income among those family members who are deserving or undeserving, but it reduces tax rates, and you use 678 trusts. That's a pretty good technique. Disadvantages, you got to pay me to form it. You got to keep track of it. You can't get the 179 deduction for assets put into place by a complex trust, but you still get the 168K deduction, which isn't so bad, also known as Special K to those of us who grew up with Kellogg cereals. Then when you set up a complex trust, if you do it for the purpose of owning and operating a business, then under the Morrissey regulations, it will be considered to be taxed as a partnership. But if mom dies or dad does this to use up part of his exemption, and then you say, oh, we just got a great business opportunity. We never expected to put this trust into a business. We just thought it would be stocks and bonds, but we got this great business opportunity to set up this aardvark farm. Now we raise aardvarks for pets, and we sell the aardvark fur to make sweaters for cats. So that would be a good example. And then if you have an aardvark farm, you're the first one in the phone book when people call and they want to farm about some kind of animal. So that could work out very well. Trustees have higher fiduciary duties than managers of an LLC, but to some extent you can handle that in the trust agreement, and to another extent you can assume that that you can appoint someone you don't really like to be the trustee, so they'll have the exposure, not you, and you can agree to indemnify them. Now, finally, I left myself 6 to 7 to 8 minutes to talk about 678 trusts, and I see that most of you are still here. The 678 trust, I already mentioned it, and the IRS regulations in 2018 on 199A did not impose any limitations on 678 trusts. So here's code section 678. A person other than the grantor will be treated as the owner of any portion of a trust with respect to which the person has a power exercisable in himself to vest the corpus or the income in himself, and the person has previously partially released or otherwise modified that power, or the person has released the power. So the safest way to make a 678 trust is to form an irrevocable trust and give that child or grandchild 30 days to withdraw everything you put in the trust. Then they don't withdraw it, and the trust is considered as owned by them for income tax purposes. Or, according to Edward Morrow, who I'm a big fan of, simply give the person the right to pull the income out of the trust. But I'm more careful, I think, and I just give a full withdrawal power for 30 days. Now, the other thing is you need to make sure that it's not a grantor trust for income tax purposes, so the grantor cannot have the right to replace assets with equal value. No one can have the right to loan to the grantor without adequate security. No one can have the right to add beneficiaries to the trust. You've got to make sure it's not a grantor trust. So then it's a 678 trust. Also, the grantor's spouse cannot be a trustee of the trust. And if anyone says they can, that is a mistake. So the downside to the 678 trust is if I set up a trust and I give my daughter 30 days to withdraw everything in the trust, then she's a beneficiary of the trust. Under Florida law, her creditors can reach into that trust to the extent that the trustee can make a distribution to her. So you want to have trust protectors who can remove her as a beneficiary or provide that she will automatically be removed as a beneficiary if she ever becomes insolvent. Because then when she's removed, the trustee can't give her anything, and therefore the creditors cannot reach into the trust. So now that 678 trust can own part of the business. That gets taxed to the daughter, even though the money can be used for the mother if you need it, or it can be sprayed to the other family members. And that trust can buy a house for the daughter. The daughter resides in the house. The daughter is considered to be the owner. And under Section 121 of the Internal Revenue Code, when the home is sold, the daughter gets the $250,000 exclusion from capital gains, and the daughter gets the $10,000, up to $10,000 tax deduction for the real estate taxes paid by the trust. So that is the 678 trust. I'll come back to the video in a second. One other thing I wanted to show you is that we do have a list here of 199A strategies and opportunities. And it begins on page 121. And I think I've covered most of these things, if not all of them. But otherwise, if not, you can go through that to your enjoyment. And it also works well for marijuana businesses. You get that 20% deduction even though you can't deduct anything else. So that's important. Okay, I didn't mean that marijuana is important. I meant that the deduction is important. All right, so with 2 minutes to go, also known as 3/10 of a billable hour to many of you, I attempt to find the video This is my granddaughter, Ava. She was, I think, 6 or 7 months when we gave this talk together. And I hope that you enjoy it. Take it away, Kelsey, our technical director.
I want to introduce you to the newest member of my law firm. And her name is Ava Archer. And she was born right next door to here, right? She was born right next door to here on September 11th this year. And she's training to be a lawyer in my law firm. And Ava, I wanted to explain to you that I'm setting up a trust called a 678 trust, and you're going to have 30 days to make a withdrawal from that trust. But I don't want you to exercise the withdrawal power. Now, your mommy's going to be the trustee of that trust, but I can replace her anytime I want. And your grandma is going to be a beneficiary of that trust, and she has something called a power of appointment, which my friend John Blockmacher calls a power of disappointment. Now, if you play your cards right, we're going to have income go into the 678 trust. We're going to pay your income tax return fees and your income taxes. And then this trust is going to buy a 529 college savings plan for you. And then when you go to the University of Florida, this trust can buy a house for you and your polite friends to live in. And then when we sell that house at a gain, we can get up to $250,000 of income tax-free because you homestead that trust. But if you come home with a guitar player with tattoos and earrings everywhere, it's going to be all over, okay? What do you think? Okay, she's going to sign. All right, so thanks very much for attending my talk. Thanks for supporting All Children's Hospital.
Okay, so thank you very much for attending that. And by the way, the All Children's Hospital program is every year in February. Hope you can attend next February, which we hope will be live. As I said, next Saturday, Jerry Hesh and I always have a good time. We're going to talk about nuts and bolts and innovative planning strategies, and you'll get to see him interrupt me at least 15 times. And then he'll say, I know how to explain this, and then you can be the judge as to whether he actually does know how to explain it. Then we're going to talk about snowbirds the following Saturday. Also, the intersection of physical therapy and yoga. And I know a lot of us have used both and what each science means and should know about the other. On Saturday the 26th, I'm going to talk about slats, and then a new friend, a PhD in science, Dr. Raul Rosden, has been studying estate planning. Now, he teaches physics at the University of Florida, but he's going to talk about estate planning. He's got a very unique view of it. And then on April 9th, Marty Shinkman is going to join me for hot topics and best strategies for estate planning and the human aspects of estate tax planning. So we do post all of these to the YouTube website. One thing we did this morning I wanted to mention is at 9 a.m. we did a webinar on the new IRA rules, and that will be posted to our YouTube site very soon as well. But if you can't find it, just send us an email. Thanks again, and have a fantastic rest of your weekend. Special thanks to Kelsey, our technical director, because everything went perfect today. Hooray.